it is not very. If you look at common size statements, for example, it is a basis for comparing different companies because all the figures are reduced to percentages. So there is, you don't, you are not exactly, you don't face the problem of some companies having very large sales figures, very huge asset base, and some companies having very low sales figures and low asset bases. तो ऐसा लगता है जैसे कि इस तरह के दो कंपनीज जो एक दूसरे से इतने अलग हैं, ये शायद एक दूसरे से कंपेयर नहीं हो सकते हैं. लेकिन जब आप उसको कॉमन साइज स्टेटमेंट बना देते हैं, then everything is a percentage. Then if I want to actually analyze the company from the point of view of, let us say, profitability or solvency or operational efficiency, these are words which we will examine in greater detail today. We'll try to understand what these words mean, and we'll try to we'll see if we can make some sense out of it. So where are Shruti and Paresh ji today? Ab tak aaye nahi? Yes.
Sir, actually Shruti is shifting to Varanasi, so she will not join the class today and tomorrow also.
Okay. And Paresh ji, any news about Paresh ji? Let me see if he has sent any message. No, there is no message from Paresh ji. In that case, we will start the class and continue. So, Praveen ji, shall I bring up your figures? जो आपने भेजा है.
It is okay, sir.
हाँ, उसको बाहर उसको निकालते हैं and let us see what how we can, because you have made it so beautifully. Let's see how we can actually use these figures.
Okay, sir.
Just a minute here. We have Alice Rawat coming today. How nice. Good evening, Alice. Good to see you today.
Yes, sir. Good evening.
So
your screen is not visible.
Screen is not visible?
No, sir. Sir, may I join once again after leaving?
Praveen ji, can you see the screen? No. Okay, can Praveen
Yes,
ji?
sir, now it is visible.
It's visible now. No? So, Alice, before we start, can you just tell me whether you have been able to look at the videos?
Yes, sir. Some.
Did you manage to look at the videos on common size statements and index-based statements?
Yes.
So you understand what common size statements are and what index-based statements are?
Yes.
Okay, then it's fine. So basically, I had given an exercise. You can also do this exercise. Maybe you can do it tomorrow or on Monday and send it to me on WhatsApp. The exercise was that you pick two companies in the same sector. Download the data from moneycontrol.com, and then you try to prepare a common size statement and the index-based statement for 4 years or 5 years. 5 years basically. So as you can see over here, this has been made by Praveen ji, and he has made this nice statement and very nicely colored it. Each year has a different color, and this statement, as you can see, what basically he has done is, we are looking at the index base. Let us look at common size first. I think we can look at the common size statements first. March 21. If we reduce this size, it will be this is more helpful. So let's just look at this. So remember, when we look at common size statements in the balance sheet, what we are doing is we are basically taking each of the items and we are calculating the item as a percentage of the total assets or total liabilities. If you can see, the equity capital here is only 0.14% of the total. You can also see that the reserves and surplus are 71% for Glenmark Pharma. You can also see that long-term borrowings is 15.10%. Now, on the basis of only these three figures, what is the impression that you get about this company? What can you say? Anyone? Praveen ji, आप क्या कहना चाहेंगे इसके बारे में?
Sorry sir, थोड़ा
Yes, Praveen.
एक बार सर थोड़ा फिर से रिपीट कर देंगे तो मेरे लिए.
So what I am saying is that if we look at, let us say, these few of these figures which you have put. For example, if you look at Glenmark Pharma March 21 and you look at the total share capital, you find that the total share capital is 0.14% of the total liabilities. Out of all the sources of funds that Glenmark Pharma has, the share capital is only 0.14%. And then the reserves and surplus are almost 72%, as you can see over here. And then you find that long-term borrowings, or let's say the total non-current liabilities, is 16%. What I'm saying is, based on these three figures, what is the conclusion that we can draw? Equity 0.14, reserves and surplus 72, and non-current liabilities, including the long-term borrowings, is 16%.
I think they are in little bit.
Because see, if you, by preparing this statement, the purpose is to try to understand how these companies are actually working a little better. So unless we try to apply our mind to the figures and what we see, it is difficult. Just make an attempt, then I'll also explain. See, when anybody else, Alice?
Actually, sir, no idea, so I can't explain that one. If any explanation, then further we can decide what to do with these statements.
Okay, doesn't matter, Praveen. We'll see that. Alice, do you have a view on this? Tanya? See, what is equity? The firm, look at it this way. This particular company, Glenmark Pharma, this company has, to do its business, it needs money. Where has it got its money? It has got its money, the amount invested by the promoters and by the public. That is, if you look at the figure, it is 28.22 million. That means it is roughly 2.8 crores. This amount they took from the public. So what is that? 0.14% of the total. Out of the total funds that they need to conduct the business, 0.14% only they have given on their own. Apart from that, over the years, this is the old company, they have managed to earn 14,781 crores, 1,478 crores or 14,781 million rupees, which is 71% of the total funds that it has. तो अपना पैसा ये कितने लगाए थे शुरू? Only 2.8 crores. Every year they were able to make profits. And since the time of the incorporation of the company up till today, what are the total profits that this company has made? It has managed to accumulate almost 14,782 crores, million. So 71% of the funds that this company has is coming from its own profits. What is the significance of this? इस पर interest नहीं लगता है. This is a free fund for the company. These are its own funds. What is the amount of borrowed fund? Anyone? Praveen ji? What is the amount of borrowed funds here?
That is, sir, 3,304.
Which is equal to 16%. Only 16% of the total funds that this company has. See, you are taking this as the base, no? Total. The total capital and liabilities are the base, 100%. So out of 20,617 crores of funds that this company actually uses, you can see that almost 15,000 is coming from its own profits. About 3 crores they had put in. And they have borrowed only 3,000 crores. And when we look in terms of percentages, we find that 15% only has been borrowed, long-term borrowing. And if we include other long-term liabilities, then we find that about 16% has been borrowed. So that means that the interest cost, the cost of funds for this company is very low because they are using their own funds. There is no pressure on them to pay. Only whatever profits they make, that they are giving as dividends. Apart from that, dividend payment is something which they are making from their own profits. The amount that they give as dividends is a decision which the company management is making. There is no pressure from anyone. The bank is not after them, pay me my interest, pay me this, pay me that. This is the beauty of the financing structure of Glenmark Pharma. Now, suppose you compare this with Ajanta. What do you find? In Ajanta, you see, on this basis, Praveen ji, can you make some sort of comment on what has happened in Ajanta?
Sir, they have also the less borrowings from the other side. That is 3.71%.
Only, yes.
Only 3.71.
And their original capital was how much?
Original capital, no, sir? Just a minute. It's total 3,532, sir.
No, see, 3,532 is the total funds.
Sorry. There is total shareholders fund, no, sir. There were 2,884.
See, please try to understand this part. 2,884 is the total shareholders funds. When they started the business, how much money did they put in?
17.39. 17.39.
Yes. Only 17.39 million, 1.7 crores is a fund which has been brought by shareholders. That's all. The rest of it, this 2,867 crores, has been earned through profit. See, whenever we see this reserves and surplus, you have to ask yourself the question, where is this money coming from? And the answer to that is, this money is coming from the accumulated profits of the company. Every year since the operation of its company, this particular company has been making profits. Some of that profit is being distributed to the shareholders as dividend. The remaining profits are being retained within the company, and that they are keeping that in this reserves and surplus. So here also you can see that almost 81.68% of the total funds that this company has is basically its own money. You understand, Praveen?
Yes, yes, sir. Yes, sir. It's clear, sir.
This is the benefit of converting data into common size. So what you can see here is that you are taking two companies. One is a multinational, one is an Indian company. In both cases, you are seeing that they are relying almost entirely on their own funds. Now, this was 21. If we look at, let's say, Glenmark Pharma let us go to 17. See here, what is happening is, if you go to Glenmark in 17, you can see that the amount of capital that they had invested, 28.22, that remains the same. This is the same figure, 28.22, which you have here in 2021. See, it is the same figure. That means over this period, they have not actually brought in any fresh capital by way of shares. The promoters or the shareholders, they have not contributed anything else. So look at one more thing. What is the reserves and surplus position in March 17, Praveenji?
That is 67.40, 67.20.
And in amount? And in amount is 9,408 crores. Okay,
Yes.
very good. See, this 9,408 crores is increasing to 10,363 crores in 18. It increases to 11,913 crores in 19. It goes up to 13,198 crores in 20. And then it goes up to 14,781 million in March 21. That means almost every year it is increasing by almost, you can say something like 100 crores per year. So where are they getting this money? This money is coming from the profits that the company is making. And when we look at the profit and loss statement, we will begin to see where this money came from. So you can make a note somewhere that we should check the profit and loss and see what is happening there. Let us look at some other parameter. Let's look at Ajanta. In Ajanta, you can see, what is the figure here, Praveenji, in 17? The reserves and surplus figure?
1486.25 crore.
In 17?
In 17, it's raised to 1913.81.
So that means it has increased by almost 500 million. That means 50 crores. And then see what happens is, from 1950 crores it increased here, or if you want to stay in million, then it has increased by 500 million. Then it has gone up from 19 to 21. That's another 200 million. Then it has gone up to 24, 300 million more. And then from 24, it has gone up to 28. So you can see, if you begin at 19, from 1900, 17 was 1400. From 1400, it has gone up to 2,867 million. This is the profit which Ajanta Pharma has made over these years, which it has retained. Remember, whenever we have profits, we are saying that some part of this profit is going as dividend and some part of the profit is being retained within the company. So here what we are seeing is that both these companies which you have chosen are very, very profitable that way. In each case, they are managing to finance their activities from their own funds. Okay, let us look at the borrowings now. See, this is the borrowings, row number 13. So let's take this borrowing side. Let's take the full borrowings. That way it will be better. Okay, let's just take long-term borrowings. Come. So you can see Ajanta Pharma has not taken any borrowing, long-term borrowing from 17 till 21. They have not taken any long-term borrowing at all. So in their plan, in the capital structure that this has, remember capital structure, when we talked about it, we said that it is basically about understanding how much is coming from debt and how much is coming from equity. So when we look at Ajanta Pharma, what we can see is that over the years 17 to 21, these 5 years, they have not taken a single paisa of long-term borrowings. They have some other long-term liabilities, which are very, very small if you look at it, 0.59%. They have some tax liabilities, which is a different issue altogether. A tax liability means that maybe they have not paid tax, it is disputed, there is something there because of which they are showing it as a liability. They have not paid it, they may have to pay it. It's something like that. Or they will pay it in the future, maybe they are contesting the amount, something like that. But otherwise, if you look at this, they do not have any serious borrowing at all. So this is their policy. If you look at Glenmark Pharma, Praveen ji, help me here. What do you see in this row number 13?
Row number 13. So in 2017, they have 2,589.35 crore.
Yes.
In 18, they have 2,686.
So it has increased a little.
Increased later, but in percentage, it was
yes.
decreasing. Yes.
Exactly. Then in 19, it has gone to 2831. And once again, it is the same. It is at 16.52%. In March 20, it has gone up to 3131. Again,
and 31 withdrawal in 21.
In 21. And it is, but the percentage is continuously going down.
Yes, sir.
It is continuously going down. So once again, we can see from here, you are getting a very good idea about the capital structure of these two companies. Where do they get the money they do their business from? This part of the balance sheet, now what we just looked at, this is the question which it is answering. So equity, debt. In the debt, we are looking at basically all the non-current liabilities. But in the non-current liabilities, mostly we are interested in this long-term borrowings. Remember, long-term provisions which are here. For example, a provision, can anyone tell me what a provision is?
Provision to be keep reserve for the future purpose key if you will take amount in that case.
A kind of budget.
Once again?
A kind of budget.
Not budget. See, it is some money which you are setting aside from your profits to meet some contingency. You are anticipating that you may need this money for some expense which has been incurred but which has not been paid for. Maybe there are some, you have sold some, let's say, of your pharmaceuticals to some buyers and you have not received payment. And now it's a long time since you received payment. You are not sure whether you will receive payment or not. You are trying to get the payment. So far, you are not getting it. So what you are doing is to be very, conservative and to be very clean. What you are doing is you are creating a provision. So whenever you create a provision like this, it means that you have shown this as an expense. This has been reduced from your profit. Okay, so this is the meaning of the word provision here. So this is one. Then if you look at the current liabilities, what story does this tell us? If you look at the current liabilities of, let's say, Glenmark Pharma, what can we say about this? These current liabilities, just to remind you, they are those liabilities which are payable maximum within 1 year. In practice, it will not be more than 1 or 2 months. But the maximum it can be is 1 year. If it is more than 1 year, that means you have taken money from someone, not exactly money, but you have taken, let's say, goods, or you have taken services from someone else. You have not paid for it. That person is allowing you to pay at a later date, but not later than 1 year. So if it is within 1 year, it is considered to be a current liability. Now here, if you look at this current liabilities, what are some of the things which you can look at? Praveenji, try this again. Let's try the first figure here.
Excuse me, sir.
Yes, Tanya.
1 minute. Sir, you told about that short-term provision. Sir, please tell once more, sir, what is provision? तब exactly आपने क्या बताया था provision होता क्या है?
Provision is basically money that is set aside for meeting an expense, which may happen. For example, if I am, let's say I give, these are pharmaceutical companies. Let's say that they made huge consignments of, they delivered huge consignments of medicine to the Indian Army. Just an example. I'm just assuming that it's a big buyer. So let's say that they gave huge consignments. Now what happened was that after giving it, they did not receive the money from the government. There was some problem with the prices, something happened, they did not receive. But remember, this has already been shown as income, because when they make a sale, whether it is on credit or whether it is in cash, it is considered to be income. Now, after 1 year, they find that this money is not paid. Let us say it is this amount only, 17.93, which is shown as provision. Let's say this amount is being shown as in their sales figures, credit sales figures, they find that this amount is not being paid for many years by the Indian government. Now what happens is, if they continue to show this as a payable, then it is wrong, because all the current, see, they could have shown it here. Look at this part, trade payable. This amount, if it relates to a sale of medicine, and it is not paid, it is a credit sale, it should have been shown in this column here. Trade payables. Trade payables is what? Where you are expecting payment from those buyers who have been given supplies of medicine but who have not paid. Now, this 17, but like I said, this is a current liability. Therefore, it should only be having a life of 1 year. Let's say for more than 1 year, this 17.93, which was originally being shown here, is not paid. Then what will happen? This amount is now not being paid. It was shown as profits previously. Therefore, now what you do is you take some money out of your existing profits and you create this particular provision. This provision means, in case this money is not paid by the government, then you will use this money to settle that account. Do you understand, Tanya?
Yes, sir. Now I understood.
So that is the meaning of, so all businesses have certain provisions. In banks, the provision relate to loans provisions. Suppose somebody does not pay back a loan, then we create provisions for that. In case the loan is not paid back, we will use this provision to adjust the loan. So it's the same thing out here. Now, coming back to current liabilities, yes, Praveenji, you were telling me about current liabilities.
In current liabilities, short-term borrowing is very nearby 2.49%, that is 513 crore.
Okay.
That is mean it is total capital and liability is only 2.49. So this
Okay.
is also a good sign for any company. I think
Okay.
they have.
We will discuss that point later. But for the
Okay.
moment, you can
then-
see that it is 2.49%. Trade payable is how much?
Trade payable is 1,622 crore.
Or
Other
about,
1,622.67 crore.
yes.
And other current liability is 258 crore.
Hmm.
And short-term provision is 109.28 crore.
Go. Okay. So,
Yes.
and we get a total of 250.
2,503.
Okay, fine. Now, in this, if you see, the biggest chunk is the payable. Now, if the biggest chunk is payable, this is probably correct. This is a good thing to have lots of, in the current liabilities, to have a larger amount in payables is probably a good sign. See, what is payable? Praveenji, can you explain?
Now, which in trade we have to pay some amount to our
Payable
digital.
means, so you have basically bought something. You have bought supplies from someone, and those supplies that you have bought, those are actually, you have not paid for it. So since you have not paid for it, it is a payable. At some point within the next 1 year, you will have to pay. So it is being shown over here. Now, you can see that they are getting almost 8% of credit of, they are not paying 8% of the amounts they are buying. In one way of speaking, you can think of this as funds which are available to the company to purchase supplies at zero interest. In some, it is like that, no? Because they need money to basically make to buy the raw material to make the medicine. Now, they have bought the raw material, but because of the fact that they are a bulk buyer, they have a lot of bargaining capacity, they have told the supplier that we will pay you in the future. For the moment, they are getting this short-term credit at 0% interest. This is one conclusion which you can draw. So if this figure is very large, this 7.8%, this percentage is large, it means two things. It means that the suppliers who give raw materials to this company, they trust the company. Their company is reliable. The company will pay them back in the future. Number two, they cannot deny them credit. When the company says that we will not pay today, we will pay sometime in the future, the buyers cannot actually deny them the credit. They cannot deny, because this company is a very big buyer. It has a lot of market power. Are you people understanding this?
Yes, sir. In simple words, sir, that is a credit worthiness of any company.
Credit worthiness is one aspect. दूसरा aspect एक और है. That company has, in management, it is called bargaining power.
Yes, sir.
Because otherwise, nobody wants to give credit. No? But this company is taking credit mainly because of the fact that it has the power to force the supplier to give it credit. And this is why it is here. Now, if you look at this figure across over the years, you can see that it used to be as high as 10.48%, but it has been reduced to 10.19, 9.73, 8.36, and then to 7.87. See, now, because you have 5 years figures with you, this is telling you another story. What this is telling you is that this particular company is now gradually reducing the amount of payables. Over the years, it is reducing the amount of payables in terms of percentage. So this is a management policy that we will not have so many payables. Now you can ask yourself the question, if they were getting this for free, why did they allow the percentage to go down? This question can come. No? I have been telling you right now that the company has a lot of bargaining power. Therefore, it asks its suppliers to give it credit, and this credit which it gets is basically almost free. Now, one thing which happens, this is not in the figures, but which is there in the trade, which happens when you read about these things, is that when you are willing to pay in cash, normally the supplier will give you a better price. Whatever price he is charging for the raw material, if you tell him that I will pay the cash right now, take the cash now, I will not take credit, you will get the benefit of a lower price. Maybe, and this is only a, let's say, some sort of guess I'm making, maybe this company, what it is doing is that it is asking the suppliers to give it a lower price on raw material, and in return, they are saying that we will basically give you the money in cash. So because of that, also it is possible that the percentage of trade payables is going down. If you look at the figures as a whole, see, look at the total current liabilities as a whole. This also you can see 12.14. In the previous year, in 20, it was 12.60. Then if you go here, it was 13.30, 14.31, 14.09. So it is very clear what Glenmark Pharma is doing is it is consciously reducing its current liabilities. It is reducing its current liabilities. It is relying more and more on its own money. This is the one of the conclusions that you can draw from this. Okay, now let us just go to another part of this. Did you do the profit and loss account also?
No, sir. Profit and loss I have not done, sir.
Achha, you have not done that. Okay,
Yes,
it doesn't matter. What I will do is okay, let's look at the index base. In the index base, which is the base year here, 17. I think you have taken 17 as the base year.
17 is the base, sir.
17 is the base. So Tanya, did you understand this? In the index, when we say
Yes.
index-based statement, Praveen ji,
Yes,
I
sir.
asked him this question, which is the base year? So
2017, sir.
Okay, then Tanya, what does this mean?
So that from this base year,
Yes, you're on the right track. Go ahead. On this base year.
so from this base year, the
See, each of the figures which are here are
is
basically
compared with being
Yes.
compared with
with the base.
this particular year.
Yes, and whatever percentage it is of the base year, that is being taken. So it will not reflect in equity capital because, as you can see, equity capital in the base year was 28.22. It has remained 28.22. So if the base is 100, everything else is also 100 because the figure has not changed. Now, if you go to reserves, you can see that if I take 17 as the base, 100, then it has gone up to 110, 126, 140, 157 in 21. Now, straight away, what can you see from this? Praveen ji, anything?
Yes, sir. Hello.
Yes, Praveen ji.
Yes, sir. That means equity share capital is remaining same, and
Hmm.
reserve and surplus is increasing year by year.
Ha.
Okay, sir. And so that also affect their total shareholder fund. Then in current non-current liabilities.
Nay, 1 minute, 1 minute. See,
Yes.
why this helps us? See, that the reserves and surplus is increasing, that is visible here also. See, from it has gone up from 9 to 14. But look at it in percentage terms. It has increased by 57% in the 5 years from 17 to 21.
Yes, sir. Yes.
This is how that base year is giving you a very good picture of how much increase is happening. So this is what the point I was making initially, that these pharma companies, what they are doing is they are basically using their own funds to expand. And you can see why. 57% increase in the reserves and surplus. Now, okay, next, what can you see with, let's say, the borrowings? The borrowings, you can see, have increased by, this is borrowings. This is the borrowings. Praveenji?
Yes, sir. Long-term borrowing is also increased from 100 to 120.
So 20% increase in the borrowings. Now, see, this one here, 107 to 7970, here we need to understand one of the shortcomings of the statement. That means index-based statements will not work properly when the figure is very small in the base. See here. The figure for this particular head, which is other long-term liabilities, in the base year 2017 is only 2.41. And it has increased to 192. So basically what is happening is, when we look at it in percentage terms, we find that it has increased by
533.
So look at the percentage increase here. It has increased by more than
8,400.
7,997 times it has increased. So this particular, this sort of thing is, the problem here is that you cannot, it has increased by about 80 times. Let's put it like this. This is in percentage now. So you will just go 2 decimals this way. So 79.70 or say 80 times. This is giving you it is giving you a deceptive figure, not very nice, but it gives us one learning. When the base is very small, then index-based statements will not actually help. So in the books also they say that whenever you're using index-based statements, use it selectively. Use it only for those items where you see steady growth. In this sort of a situation, it will not help. Okay, let us look at overall non-current liabilities. You can see there is a increase from 100 here to 127. That is 27% increase is coming out here in this.
Yes.
Now, if you look at, let us take another good one, short-term borrowings. Okay.
Short-term borrowing, yes.
So what are you seeing here? We have
it is increasing by 100 to 274.
274. So almost 2.7 times increase. So it is increasing by almost 2.7 times in 5 years, short-term borrowings. So basically what they have done is they have begun to arrange for some funds on a short-term basis. This has been a part of their policy. Don't go for long-term funds, go for short-term funds, and they're doing that. You can see that the accounts payable has increased from very marginally in 5 years. only by 10%. So that is also interesting. And then you can see that other current liabilities have actually declined. See, it's 93% of this. So it is actually declining. Then you can see that provisions, short-term provisions here, this again you can see is increasing by 2.6 times. So there are certain regions where the company feels that they have to make provisions, maybe because they are not sure whether they will be able to get back the money from those buyers who have bought on credit. This is the only thing I can think of. Apart from this, there is nothing much which is interesting here. Total capital liabilities, of course, we can see that total capital liabilities have increased by
47%.
By 47%. So that is one. If we look at, these will not be very interesting. In the current asset side, we can see something here. Trade receivables. Let's look at this. So the receivables, you can see, receivables are basically, anyone? Can someone explain what receivables are?
The money which are going to be received in future when we have sold on the credit.
Yes. So this is a credit sale. We have sold on credit. So here you can see, what does this tell you? 100, it has gone down to 64.15%. Anything, Pravinji?
We have avoided the credit sale.
Yes, yes. We are gradually reducing the credit sales. See, in this period, you can see that the amount has gone down, even though the sales would have gone up. It is not possible that in 5 years, the sales of this company have not gone up. Definitely, it would have gone up. It is doing so well. It would have definitely gone up. But the actual amount of receivables has gone down. That means in percentage terms, the receivables have actually gone down. I think we can go back to common size and see that. So if we go to common size and we go to receivables, we should be able to see this. Which company were we looking at? Ajanta or Glenmark? We were looking at Glenmark. No? Okay, fine. Glenmark. So if we go back, actually you can see it here also. It's quite visible. If you look at the actual figures also, now you can see how from 3,879 it has gone down to 2,488. And this almost 1,400 million reduction has taken place in the receivables, despite the fact that in these same 5 years, the sales would have gone up substantially. So the company is now using its bargaining power not to give credit. Basically, this is the all good, powerful companies which have a, let's say, what shall I say? They have a grip on the market. ये ऐसे कंपनीज हैं जिनके पास इस तरह के प्रोडक्ट्स हैं कि कोई इनको ना नहीं कर सकता. लोगों को जरूरत है उस प्रोडक्ट की, इसलिए वो इस कंपनी से खरीदने पर मजबूर है. और इसलिए ये कंपनी उस पावर को यूज करती है टू sell in cash only and not give credit. And you are seeing that very clearly here. So basically what we are seeing here is when we use these common size and index based statements, it allows us to form a fairly good picture of the company. This is the main value of looking at this. Now, I will take you to some figures which Shruti had sent with regard where we can also see the profit and loss figures. So, just a minute. I think it's the same problem. Even Shruti has not sent the profit and loss statements. Okay, doesn't matter. If it is not there, then in that case, we will go to the next part. So hopefully, this discussion of common size and index-based statements prepared by you, will have given you an idea about how useful this can be in analyzing. Now, what I want to stress is that while this is a good tool to analyze, probably you will find that financial ratios, which we are going to do today, are an even better tool to basically understand these statements. Because see, in financial ratios, what we are doing is we are taking different items of the balance sheet and profit loss account, and we are trying to use that to form relationships between these items. And when we form these relationships, and particularly when we look at them over a 5-year period or a long period, 5 years, 4 years, 3 years, you begin to see the trend, and you are able to understand how well this company is doing, where its strengths are, where its weaknesses are. It is easier to understand it in that case. Now, the other thing is that many items do not have any meaning if you see it in isolation. For example, if you see the profit figure in isolation, only the profit, let's say, is given, you find that one company is making 100 crores of profit per year. There is another company which is making 200 crores of profit per year. Now, if only these two figures are given to you, you might conclude that the company which is making 200 crores of profit is better, is more efficient. But if I were to give you the sales figures of both these companies and then compare the profit figure to the sales figure, let's say the sales in both companies was the same. In both cases, let us say the sales was only 1,000 crores. Now, in 1,000 crores sales, one company is making 100, another company is making 200. You can now see exactly how much better this company is, the one which is making 200. Or, for example, if I give you another way of looking at it, if the company with 200 is making this profit from sales of 4,000, then practically speaking, it is a very, very low profit which it is getting. Whereas this company from 100 is making, from 1,000 crores is making 100, it is making a 10% profit. So basic point is, when I compare different items with the appropriate base, like for example, if I'm comparing profit, the appropriate base figure is sales. So if I begin to look at it that way, then I'm in a position to actually understand how good my company is. So that is the interesting thing. So like I say over here, a profit of 100 against sales of 1,000 is 10%. A profit of 100 against sales of 2,000 is only 5%. So both of them may be making 100, but one company is doing so much better than the other. Without the base figure of sales, we cannot take a view on how good profit is. So this is one thing to remember. Now, let us just look at, see, this particular slide which I am giving you. This has all the major ratios that we propose to discuss. And if you do this much of ratio analysis for any company, you will be able to analyze the working of the company and to see just how good it is. So basically, you may find that in some, in some books, instead of having profitability and solvency only, you may find that efficiency is the third category. There will be profitability, there will be solvency, there will be efficiency. Some might use the word turnover. Here in this particular format, what the author has done is, they have divided all the ratios into only two parts, profitability and solvency. Now, profitability is very clear. We all understand profitability to mean how much profit does a company make from its business. Now, to understand that profitability, we look at four things. The margin on sales, what we just mentioned, if from sales of 1,000, company makes a profit of 100, this is a sales margin. Then the return on investment. See, this is important because we are trying to understand this from the point of view of the investor, the persons who put up money, the guys who put up the capital to finance the company. We are trying to look at it from their point of view. What return are they getting? So this is one. Then we look at efficiency. So the assets that the company has, these are the assets which are used for the purpose of, let's say, generating profit or generating income. So how efficiently are they using these assets? And the last one, we look from the point of view of a simple shareholder. What is the return per share of equity or the earning per share? So profitability is basically divided into these different sections. So margin on sales, we look at gross profit margin, net profit margin, and operating profit margin. In the case of return on investment, we look at operating profit as in ratio to operating assets. Return on total assets, that means the net income or profit after tax in relation to the total assets that the company has. And return on equity is the profit after tax in relation to the amount of shareholders' funds. So these are return on investment. Efficiency in use of assets is about turnover, total asset turnover, operating asset turnover, working capital turnover. We'll try to understand these, why the word turnover is used. We can see this. Turnover basically is the repeated use of something. So as we look at these, we will see that there are some companies which on the same asset base are able to get a better turnover than other companies. And there are other companies which don't do that way. Then we will look at it from the point of view of the individual shareholder and try to see earnings per share, dividends per share, dividend payout ratio. So when we do all these, we will end up with a fairly good idea about the profitability of the company. And then we look at solvency. So can anyone tell me what solvency is?
It's company's capacity to either recover or to pay.
Capacity to?
Capacity to pay or recover some amount.
No, not recover. The company's capacity to
Sorry, pay.
to repay its debts. Whatever liabilities that the company has, the long-term liabilities, the short-term liabilities, its capacity to repay these, that is normally referred to as solvency. So here in solvency, we again look at it in three segments. The first part is short-term solvency. Then there is operating cycle activities, and then there is long-term solvency. So we look at this under these three, and in short-term solvency, we look at some very well-known ratios known as the current ratio, quick ratio, average daily expenses, cash cover for daily expenses. Operating cycle, we again look at receivable turnover, average collection period, inventory turnover, inventory conversion period, average payables period. So basically, the credit sales and the credit purchases, those are related to the operating cycle. So when a company does business, it initially buys raw materials or stock from its suppliers, and some of these are bought on credit. So we need to understand how good the company is in paying this. Does it have the capacity to pay back comfortably that amount which it has bought on credit? That is number one. The other side, so that is the payable side. What is the average time it takes to repay any bill for an item bought on credit? And then we also need to understand this receivable turnover. When the company sells on credit, how long does it take to recover the money from the buyer? Because these two are related. In one case, you are giving goods to your buyer. If you get that money back fast, it gives you more liquidity and it enables you to pay your own suppliers. If there is a delay in getting the money back from the buyers, then there is a problem. Then you will again have to find funds to repay for the payables. So, and then the inventory turnover, this again gives you an idea about the way the company manages its inventories. How much inventory does it use to produce a certain amount of goods? How long is this conversion period? Because the longer this period is, or let's say the longer any of these periods are, the more liquidity the company will need to repay its liabilities. And finally, of course, you have the long-term solvency position. That means whatever long-term loans, long-term borrowings the company has taken, that is related to this part. So you have the total debt to total capital, long-term debt to total capital, interest cover, and equity multiplier. And in relation to this, we will also look at something called a DuPont analysis. Fancy word, it's after a French gentleman named DuPont, but it will give you a very good insight into the way it works. So we'll take a short break and then we'll get back it's 7:07 right now. So I'll come back, let's say by 7:12, 7:30. Okay?
Okay, sir. Sir, there Pareshji and Shruti and many students are not there. So again,
Yes?
Pareshji and Shruti is not there. So again, you have to repeat, I think, because Pareshji is new to this financial loan, I think.
Okay, we'll see. We'll see what we need to do. No problem.
Okay, sir.
Fine. So I'm back, and I hope all of you are there. Praveen ji, Tanya, Alice, are you there? Yes. Okay. Okay, fine. So I will now start off with or continue with the financial ratios that we were doing. So like I said then, we will basically discuss all the basic ratios with examples. The examples have been taken from one big company, Colgate Palmolive India Limited, CPIL. Colgate Palmolive India Limited, the main product which all of us are familiar with, many of us use, is basically Colgate toothpaste. We all know that it's a multinational company. Its sales, see, when you say Colgate Palmolive India Limited, you are talking about the operations of this company in India and Nepal. So all the sales of products in India and Nepal are basically, it is that sale that we refer to whenever we show you any data with relation to that company. And all the slides that I have, all the examples that are there, are taken from the actual balance sheets and profit loss accounts of Colgate Palmolive India Limited. So we'll start with the first part, margin on sales. Now, margin on sales, when we say this, first you have to look at the income statement itself, the profit and loss statement. So here we see the total sales figure. We have taken 2 years. It doesn't matter whether it's 12, 13, or whether we take 14, 15, or 16, 17. From the point of view of understanding the figures, I think it's all the same. Now, here we are taking the total income statement from sales right up to the profit after tax. And as it happens, the dividend also is given here. But we are mostly interested in the figures up to profit after tax. Now, so let's take the first one. You have sales, you have other income, and you have cost of goods sold. Now, other income, anybody wants to explain this? What other income is? See, when we say total sales, this means that this figure here, these two figures, represent the amount of money received for goods that have been sold either in cash or on credit. This is the first thing to remember. The other income is not coming from sales. It is not coming from the business itself. It is coming from an investment. The company has used some of the profits that it made and invested that money in some other security. Maybe it put it in a mutual fund. Maybe it invested it in some other allied concern. From there, it was able to generate some income. And whatever income it got, that is being shown here in other income. But that also means that it is different from the amount which is being earned in this business. First thing to remember. Now, what is the margin? What is the profit that the company earns from the business itself? So what we see is that if you take the gross profit, this is the profit that it is making, 19,636. And if you take this figure here, the total sales figure, if you take this and you basically divide this by this, you will get the actual gross profit margin. It is telling you one simple thing: how profitable is this company? When the company basically sells 1 unit of goods, how much profit does it make? 10%, 15%, 20%? What is the profit that it is actually making? So here you can see that the actual input cost of the goods which are sold is 12,501. And it is managing to generate a sales of 31,000. So it's a huge profit margin that they already have here. So the first thing that we have is operating profit is to sales. So this particular part here, operating profit. So this is the gross profit margin, the first ratio that we looked at. Very simple. We are just relating sales to cost of goods sold. So remember, cost of goods sold is you are only looking at the amount it took to produce the goods. You are not looking at the other expenses. These expenses, sales, general and admin expenses, are not being taken. Now, in the case of Colgate-Palmolive India Limited, what do you think is the largest head here in sales, general and admin expenses? See, it's an FMCG company. It is buying goods from somewhere. It is selling it. It is producing some of the goods. Some of the goods are actually being contracted to other manufacturers. They have a huge margin there. So we look at this, we look at the actual figure, but basically we are relating this total sales 31,638 with cost of goods sold 12,501 and the gross profit of 19,636. Now, this particular expense, 12,556, as you can see, this is higher than the actual cost of goods. Why? Anyone? Any guesses? What could be the main part here?
That is related to salaries to employees and office
okay.
expenses.
That is true, Praveenji. But do you think that producing the goods, all let's say labor costs, raw material costs, factory overhead costs, all that is actually less than the payment being made to employees? It can't be. There is something else which is coming here, which is very large, which is very big. What can it be? Think of it this way.
Office expense, office.
No. It cannot be this much.
Marketing.
Yes.
Advertising.
Yes, exactly. Because in all these fast-moving consumer good companies which are selling these products, it is very competitive. To make sure that you and me both buy Colgate, they have to continuously show the advertisements on TV, in magazines, in social media. It's always there. It is always visible that this product is there. So the huge expense is incurred on the marketing side. And therefore, when we take out all these expenses, the major expense, of course, being marketing, from the gross profit, we are left with profit before depreciation, interest, and tax, 7,080. And this is known as the operating profit. This PBDIT, this is basically known as the operating profit. This is the profit which you are getting after taking care of all your marketing and sales expenses, your salary expenses. Everything basically has been taken care of here, except two things. The depreciation cost, and remember, depreciation is not an outflow. And the second thing which has been taken care of is the finance cost. So traditionally, you do not consider the finance cost here. You just want to find out if the operations were entirely financed by the company itself, what is the margin that it would have made? That is the basic purpose here. So cost of goods sold, I have the sales, I take out cost of goods sold, I'm getting the gross profit. From the gross profits, I take out all the operating expenses, mainly this sales, general and admin expenses, mainly the marketing side will be contributing the highest in a FMCG company. And when I do that, I begin to get the operating profit. And when I take the operating profit and I divide that by the sales figure, I begin to get the actual operating profit margin. So from the operating profit margin, I can understand the profitability of the operations of the company. And it reflects the performance of the management. Remember, how good has the management been in managing to reduce costs, in managing to increase sales? How good has their strategy been? They have, put up an extensive marketing campaign on TV, on social media. They've done all that. Apart from that, they have a network of dealerships. They have, extensive rural marketing campaigns, because products, FMCG products, have to be sold not just in the metros and in the tier 2 and tier 3 cities. They also have to be sold in the rural areas. So all these FMCG companies have a huge dealership, a huge network of salespeople who are able to take these products and deliver them to the smallest shop. So all these things, you are beginning to understand what the operating profit is and how well has the management performed. That is the basic thing here. So the level of operating profit depends on the company's ability to maintain a sufficient volume of sales and gross profit margin. So the sales have to be good, and at the same time, the margin on the sales have to be good. If these two are good, and if you can control the operating expenses, you will end up with a good operating profit margin. And remember, the operating profit margin is very important for whom? For the marketing people. The marketing people are most concerned about this, because they are the people who are spending most of the company's money in making sure that the company's products are sold. But if tomorrow they find that they are spending so much money that the operating profit margin is going down, then it means they will have to think of some other strategy. That is the thing which you need to remember here. So the marketing strategy influences the advertising, selling, and distribution expenses. So it is important for FMCG companies whose sales are driven by marketing. So an FMCG company like Colgate-Palmolive India Limited will be very interested in following this figure. How well are they doing here? Is this figure better than last year's? Or in an index-based system, is it better than the base year? So this is what, are all of you understanding this? How the profitability ratio is helping you to...
Yes, sir. Yes, sir.
Now let's go to the net profit margin. Now the net profit margin is basically you are taking the net income, profit after tax. So depreciation, interest, tax, everything has been reduced from the operating profit. Whatever is left, that is the net profit. And that amount, if I take it as a percentage of sales, this is the actual amount which is available to shareholders. And this is influenced by three things: the operating efficiency, which we saw in the operating profit margin, in the financing costs, the next part, because we'll then be deducting the interest costs, and in taxation. Now you don't have control over taxation. How much of tax the government is going to charge, that is something, a decision which you have to accept. But you have an influence over the operating efficiency and the financing costs. Financing costs, because you will have to negotiate with different banks, or you may decide to go for a bond issue. You will have to choose that particular means of financing, which is the most cost effective for you. So if you can get these three things in order, it will help you to get the best net profit margin. Now, in this example that we had just seen, okay. Now, let's look at another one, return on investment. Now, in the case of return on investment, we have three things to look at: operating profit to operating assets, return on total assets, and return on equity. So here, just give me a moment, please. Okay, coming back to this, let's look at this. So profitability will not exist in a vacuum. No? We have to see it in terms of the resources that are being used to generate the profit. Now, the management has to be evaluated on how successful they have been in profitably utilizing the assets. So the investors have given a certain amount of funds to the company. Some funds have been borrowed. All these funds have been used to create assets. And the assets that have been created, the more efficiently they are used, the more profit you will get. That is the basic concept. Now, how well the management does, you can see from these figures. So for this, assets have to be related to profit earned. So the first part is operating profit to operating assets. What are the operating assets? Operating assets are basically the current assets. So when we were looking at Praveenji's, the figures which he had given for those two pharma companies, we also saw very clearly the current assets and fixed assets. Fixed assets we did not spend so much time with, but we all understand that fixed assets are basically land and buildings, machinery, some of the intangible assets like patents and licenses, etc. That part. Now, if you add all the current assets, cash and bank balances, inventories, receivables, those are the current assets. If you take that and you add the fixed assets, basically these are the assets that the business is using to generate income. These are the only assets that the business has. Any other assets that it has, let us say that the business has invested some of its previous year's profits in some other company. If it has taken some of this and let's say it has invested it in a mutual fund, in that case, what will happen is that it will not be an operating asset. That is the basic thing. So basically, even cash which is lying idle, even that is not considered to be an operating asset, because that cash is not being used for the business. The cash has been earned in some previous year. It is lying in the bank. It is not being used currently. Therefore, it is not considered to be an operating asset. So first of all, to find out my operating assets, there are two ways. Either I just take current assets, I minus cash from that. Are you getting this, all of you? This why cash is not taken?
Yes, sir.
Tanya, you're very quiet. Alice?
Yes.
Okay. Are you following the lecture, Alice?
Yes, sir.
Yes.
Okay, fine. So current assets, we take out the cash from that because the cash is actually not helping with the operations. It is just lying idle. And to this figure, you can call it something like net current assets because you are taking away cash. You add the fixed assets. What you will get will be the operating assets. Another way of getting this is you start with total assets. you reduce other assets and cash. You reduce this from total assets, you will get your you will get your operating assets. And you should also take the average operating assets during the year. That means you take the balance of operating assets at the beginning of the year and the operating assets at the end of the year. So you will not get the assets at the beginning of the year. So what you basically do is look at last year's balance sheet and see what the operating assets were there in last year balance sheet. Take this year's balance sheet, look at what the operating assets are, add them together, divide by 2, you will get an average operating asset. Once you get your average operating asset, you are in a position to do a simple division, get your operating profit, the profit before depreciation, interest and tax that we had just seen in the last slide, divide that by the operating assets, and you will end up with your operating profit margin. Is this clear?
Yes, sir.
Okay. Now we look at another aspect. We look at the return on total assets. So far we were looking at operating assets, and we are relating this to the operating profit. Now what we are doing is we are looking at the return. Whenever you say return, it refers to profit after tax. So not the operating profit, but you are now looking at profit after tax, because after all, this is the money which is left with the company at the end. After all expenses have been paid for, everything is done, depreciation has been provided, financing costs, interest has been paid for, all that is done, tax has been paid, you are left with this amount. This amount belongs entirely to the company. So what is this as a percentage of total assets? So if this is the rate of profit the company earns after meeting the cost of financing a portion of the total assets. Average. So remember, the total assets are generated from two sources. One is the equity and reserves, as you remember the example from Glenmark Pharma, Praveenji. You remember that very small amount in equity.
Yes, sir.
Then a very big amount in reserves, shareholders' funds, then very small amount taken in debt. This is basically this is used for the purpose of creating the total assets. So some portion of debt, some portion of equity. And then once again, we will find out the average assets. So we'll take the assets at last year's balance sheet. We'll take the assets in this year's balance sheet, add them together, divide by 2. We'll get our average assets. And then we will get the ratio of net profit to these average total assets. And when we get this, we will basically find out what is the margin here. And this margin which we get, this is known as the basic earning power ratio. That means this is what the company is actually earning after all expenses have been taken care of. This amount is left. This can theoretically be given as dividend totally, or it can be invested in the company, or some part can be given as dividend and some part can be invested in the company. So on this basis, the return on total assets, this is one. The other aspect we can think of is we can take the same figures and work out return on equity. That means profit after tax, and we are dividing that by the net worth. So we are writing average net worth. That means average shareholders' funds. Shareholders' funds, of course, are equity and reserves. Equity and reserves are also known as net worth. So if you take this, you take the profit after tax, you divide it by this, the shareholders' funds, then the shareholders will find out what amount they are earning from the amount they had originally invested in the company. After all, as an investor, this is what they are most interested in. Okay, what is the return that this company is giving? So if it's not giving me a good return, maybe I want to sell my shares and move on, invest in some other company. And then the other aspect to remember is that whenever a company borrows money, if it borrows money at a certain interest rate, if it is able to get a return on equity which is higher than that interest rate, then everybody will make money. The shareholders will make money, the company will have more reserves, everything is going to be very good. And the advantage in taking debt is, or the advantage in borrowing is, that the original promoters are able to get higher return, create more assets, get higher profits, higher return on equity without actually investing their own money. They are investing the money of a bank, maybe, and paying the bank interest and later on repaying the bank for the loan that it gave them. So that is one advantage when you invest, when you take debt. So here I've given you two examples of this return on assets and return on equity. So like I said, in the case of return on total assets, what we are doing basically is we are relating the total assets to the profit after tax. Now you can see this in the case of Colgate-Palmolive. Look at these figures here. A huge figure. 42% in 11, 41% in 12, and 40.8% in FY13. Now you can see that it has decreased. Why has it decreased? For that, you will have to go to the balance sheet and the profit and loss account and see mainly the profit and loss account, and see where the expenses have gone up or where the cost of goods have gone up. Something somewhere has gone slightly differently, because of which this has happened. Now, because return on assets has decreased, therefore you can see that the return on equity has also decreased. From 113 in FY11, it has gone to 107. So please note that in both these cases, return on assets and return on equity, one figure is the same, profit after tax. Only difference is, here I am taking total assets, here I am taking only total equity. And total equity, remember, is the actual share, the amount of equity contributed by the shareholders plus the reserves and surplus. So on that base, these guys are getting a return of more than 100%. So see how profitable this company is. The total equity that they have, including the reserves and surplus, is 4896. Okay, and from their earning profit, which is more than the total equity that they have in 1 year. Each year they are earning more than the equity that they have. More than their net worth is being earned by the company in 1 year. See, this is the advantage of ratio analysis. When we saw the figures, we did not actually have any idea that this company is doing so well. But once you begin to take these figures and you put them into these, these little into different ratios, and you begin to closely look at the figures, and particularly when you study these figures over a period of time, you begin to see just how well a company is performing. So if you take only 1 year, it will give you a good idea still. You will understand that the company is very profitable, but it will not give you the trend. But if I take 3 years, I know that this company every year is giving a more than 100% return on equity, which is very, very good. And it is giving a more than 40% every year on the total assets. Why is this less than this? Because the base is higher. This total assets also includes the amount which it has taken. The current liabilities are also coming in to finance the current assets. Some short-term borrowings will be coming in. All those things are included here. That is why, so the borrowing component is increasing the this figure here. But then what is happening is that the shareholders are getting the benefit of these borrowings and they are ending up with a huge return over here. So some amount they invested, some amount they managed to earn through profits, some amount they borrowed. The total amount of all that is reflected here in the total assets. And on that, they were able to earn a return on equity of more than 100%, 113 as high as 113 in 11 and 107 in FY13. Is everyone clear on this? Are you understanding this?
Yes, sir. It is clear, sir.
Are you getting a better idea of the figures now that we are doing ratio analysis?
Yes, sir. In ratio analysis, it's clear, sir.
So this is the advantage. So it gives you, it gives you more depth than in the common size or in the index based. Common size and index based were also telling you a story. They were telling you some other stories. But here you can actually see the profitability and really understand how well the company is doing. Now, if you look at this other figure, remember we said that when we look at return on investment, we will also look at earning per share or return per share of equity. Because for most of the shareholders, thousands and thousands of shareholders who own small numbers of shares of the company, for them, it is important to know exactly what return they are getting. So basically what we are doing here is we are taking that same profit after tax figure and we are dividing that by the number of equity shares. So the per share profit is coming out. And this is very important. Other thing important for the individual shareholder is the dividend that he is getting per share. That is again very important. And also important is the dividend payout ratio. That means if 100 rupees profit is earned, how much of that is given as dividend? 50 rupees, 60 rupees, 70 rupees, or only 20 rupees? So the higher the dividend payout ratio is, the more dividend the shareholder will get. Each company has a different trend as far as different payout ratios go, because each company in each industry has different requirements. How much do they want to expand, or to how much do they, so depending on how much they want to expand, what sort of expenses what sort of capital expenses they have, they will retain a certain part of the profits and not give it out as dividends. They will keep it in reserves and surplus and use it for whatever purposes the company has. So the dividend payout ratio will be dividend divided by profit after tax multiplied by excuse me. So the higher this is, the more dividend the shareholder will get. And since we are trying to understand what the shareholder is getting actually, this is important. So this is one part. So you can see it here. This is the earning per share. Profit after tax, same figure, 4968. I am sure all of you remember this from the earlier chart that we saw.
Yes, sir.
And the number of equity shares in millions is 136. This is also in millions, by the way. We were saying crores, it didn't matter. But if you want to be very accurate, this is also in millions. This is also in millions. So earning per share is 36.5 rupees. Now you are in rupees here. Earning per share is 36.5 rupees. So it is excellent. You can say that. On each share, you are earning 36.5 rupees per share. Now we look at another aspect. This is basically the efficiency in the use of assets. So this part again is another very, very important part. How efficiently are the assets being used? So basically, we will discuss this tomorrow, but I'll just take you through some of the main points here in this slide. So we have seen profitability in terms of the profit margin on sales. So we saw it in terms of gross profit margin, operating profit margin, net profit margin. We saw all that. If for every basically 100 rupees of sales, what is the amount that the company is actually earning as profit? We were able to see this at different stages. First, at the cost by simply taking out the cost of goods sold, then taking out, getting the gross profit from there, deducting all the operating expenses, including, as we saw, the very big marketing expenses, and then finally reducing the financing costs and the depreciation costs and the tax costs and arriving at the net profit. So we saw this profit margin on sales. Now, the rate of return on assets employed is a function of both the margin on net sales and the relationship of net sales to assets used. This is the efficiency part. So return on total assets is equal to net profit by sales, that means the profit margin, multiplied by sales as a percentage of total assets. See, you can have a certain amount of assets. The amount of sales that you are able to generate from these assets, the more you do, the more sales you generate, the more efficient you will be considered, and the more profit you will earn. This is the important thing. The more sales I have from the same asset base. So remember, we said that the total assets was made up of the current assets and the fixed assets. Now, from the current assets and fixed assets, I'm using these two things to generate sales. And the sales that I generate, how much is it as a percentage of this? How many times of the total assets am I getting sales? Is it once, only once? Is it 2 times? Is it 3 times? The more it is, the more sales I have, the more profits I will make. And the more margin that I have on each unit I sell, the higher will be my final profit. So are you understanding this? One is the actual volume of sales, the other is the margin on sales. So when I combine these two things, I get the best return on total assets. So the first aspect of this, the first thing that I have to calculate here is, I have to look at the total asset turnover ratio. How do I get the total asset turnover ratio? Sales divided by average total assets. So if I take the average total assets, that means I take the total assets of from last year's balance sheet. I take the total assets from this year's balance sheet. I take these and I divide by 2. I'll get my average total assets. On the basis of this average total of assets, how much sales am I getting? And this sales which I'm getting, this is my turnover ratio. The higher this ratio is, the more efficient I am. Are you understanding this, Praveen?
Yes, sir. Yes, sir. It's clear, sir.
Tanya? Alice?
Yes.
Okay. Now, I've tried to give you this idea here from Colgate-Palmolive figures out here. So return on total assets, it's been calculated as usual for these 4 years, 10, 11, 12, and 13. So as you can see, the total assets here are given. This is basically the total of the current assets and fixed assets. So it used to be around 8,800 million in 10, increased to 10,340 million in 11, further to 11,296 million in 12, and 13,067 million in FY13. And you can see the profit figures here: 4,233, 4,026, 4,465, and 4,968. Now, what are the sales that they got? Sales are here. It used to be 19,000 on an asset base of 8,800. And it was 31,000 on an asset base of 13,067. So out here, what we have done is, based on these three figures, total assets, profit after tax, and sales, we have calculated three ratios. The first is the net profit margin. So net profit margin, what are we doing? Anyone? How are we getting this 15%, Praveenji?
Sir, 4968 divided by 31638.
Okay, very good. And this turnover, total asset turnover?
Hello. Yes, sir.
Total asset turnover, how are we getting that?
Total assets turnover, sir. Just to
So remember, we said it is sales
divided by total asset.
By average total assets. So if you assume that this is average total assets, 13067, sales figure is here. So Tanya, it is basically, what we are doing is we are taking this figure and we are dividing by this.
Total.
So as you can see, this sales figure is 2.6 times bigger than this figure. So if you multiply 13 by 2, it will be 26. This is 31. You can already see that it is more than 2. If you do the math, you will see that it is 2.6 times more. And you can see one more thing. Over the years, this has increased. It was used to be 2.3 times more. Then it became 2.5 times more. Then it became 2.6 times more. That means that the company is becoming more and more efficient. It is managing to increase its sales in relation to the total assets that it has. That is the thing to remember here. And you can also see that the return on total assets, how are we getting this? Basically, you can just multiply this with this. Remember, we said, this is the interesting thing to note here. We said that the return on total assets, one way of calculating this is I take the profit after tax and I divide by total assets. But if you want to understand the return on total assets as a function of two things, the volume of sales and the margin of sales, you can also do it here. So if you take the margin on sales of 15.7, and if you take this part here, the actual volume of sales, if I multiply these two, I will get this return on total assets. And this return on total assets will be the same as this divided by this. So this is the thing to remember out here. So when we simply take profit after tax and we divide it by the total assets, we are getting a return. We are understanding what the return on total assets are. But when we make this same figure, we get the same figure by considering it as a function of net profit margin and total asset turnover, we are able to understand that the return on total assets is actually dependent on the volume of sales and the margin on sales. Are you getting this difference? Tanya?
Yeah.
See, in the previous slide, we said something. We said that, 1 minute.
Yes, sir. Now getting your voice, sir.
Let me just come back here. See, in this slide, I told you that return on total assets is basically equal to two things. One is the net profit by sales, from which I am getting my margin, and the other was the sales turnover. This part, sales divided by average total assets. So basically, to calculate, if I want a better return, I should improve this or I should improve this, or I improve both. And this is what we are seeing here. we are taking that first part, net profit margin. So getting the
Sir, the numerator part.
Huh?
The numerator part.
Yes, we are getting that. And then we are taking the total asset turnover. And this is basically relating sales and total assets. This is relating profit and sales.
Yes.
So, and when we multiply these two things, we are getting the total return on total assets. That means if you want a higher return, you either improve this or you improve this. So either you begin to sell more or you sell the same amount but increase your profit margin. Or if you're very good at it, you sell more and you increase your profit margin. If you can do that, you will get a better return on total assets. What I want you people to understand is that whenever I think of return on total assets, I should relate it to these two things, the margin and the volume. If you have understood that, then you have understood the significance of this particular ratio analysis that we are doing.
Sir, one doubt is there. In Rota, there is a formula net profit upon sales into bracket open sales upon average total assets. But when we are putting that value, that is 4968 on the place of net profit, and 31638, that is sales. And again in another bracket, 31638, we have kept sales amount. And average total assets is 13,067.
See,
so
the total is you are taking the sales 13,638 and you are taking this 1367. Then
profit is that 4968, no?
Profit. See, you think of it in two parts, Praveen. First, you are taking 4968 and you are dividing by 31638.
Yes, sir.
You are multiplying by 100. You will get 15.7. So this 15.7% is your margin. For every 100 rupees of sales that you are making, you are earning 15.7 rupees.
Yes, sir.
And this part, when I am taking the sales figure and I am dividing by the total asset, I am finding out how many times of the total asset figure is the same. So on the same total asset base, how much more sales can I generate? So here you can see that if I take this figure, 58, and I divide by 13,067, I am getting 2.6. Now, if I multiply 15.7, the margin, by the volume, by the turnover, I will get 40.8, and that is my return on total assets. So what the lesson I am getting is that I should be able to get a good profit margin and I should be able to make more and more sales without increasing my assets. If I can do that, I will get a better return.
Okay, no, sir. Actually, there is a printing mistake. I think 2.6 place there is a 2.42. That's why I got confused. There is a calculation mistake.
Is that? I don't think so.
Check, sir. I think I have done. So
you have to reduce cash and all that. I'll show you the calculation again. We'll look at this tomorrow. I'll show it to you.
No, sir, not that. Only total assets turnover, sir. Only was 2.6 ke place pe 2.42 is there.
Tomorrow I'll clarify that. Don't worry. Tomorrow I'll clarify that part also.
Okay, sir.
No problem. But you have understood the basic thing, na?
Yes. All the basic thing is clear, sir.
Okay.
Okay.
We'll end it today. Thank you for being so participative. Very nice to see you participating so much, Praveen ji.
Thank you, sir. Appreciation.
Okay, good night, all of you. Alice, good to see you here today. And Tanya, always good to see you. So see all of you.
Good night.
See you all tomorrow. Good night.